The Commercial Real Estate Show is brought to you by CohnReznick, forward-thinking advice to navigate business and financial issues. Visit CohnReznick.com. By BB&T, banking, business, and commercial real estate loans. Visit BB&T.com. And Arnold Golden Gregory, a law firm that makes a difference. Visit AGG.com. And Bull Realty, when your business requires proven performance, visit BullRealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit FranceMediaInc.com. Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And hey, that's whatever type of company you work for. And I believe we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Well, today we're going to explore the U.S. office market. We'll share how the sector performed in 2012 and what to expect moving forward. Did the quest for safe yield heat up the office investment market? And what happened with occupancy? We'll see right now. We'll see what's hot and what's not in the office sector. Please welcome my first guest, Walter Page, Director of Research with CoStar Group. CoStar Group is the #1 provider of commercial real estate research and information services for investors, sales professionals in the United States and United Kingdom. They cover more than 59 billion square feet of commercial property, including over 7 billion square feet of space for lease. Walter Page, thanks for joining us today.
Thank you.
Well, Walter, let's get right into it. How did the office market perform in 2012?
I would say the office market performed as we expected in 2012. Vacancy fell 50 basis points to 12.3%. That was within 10 basis points of where we had expected. We expected 12.4. Net absorption was 59 million square feet. That was 7% below our forecast of 63 million square feet, but that was up 43% from 2011, which is quite a significant feat given that the economy faced some headwinds, from the fiscal cliff, national election, and a fear of a double-dip recession. Rent growth for the year ended up at 1.7% rise compared to basically flat rent growth in 2011. If you factor in a reduction in free rent concessions, rent growth was close to 2%. The first year of what I would call a significant upturn in the rent situation. So it was a pretty good year for office.
Right. And that's a good rate increase there, and that's exactly what you guys had expected?
Yes, we expected 1.9% increase in rents, so we were right on target.
Okay. Well, now you can say I told you so, right? All the doubters and naysayers. Well, which cities had the best performance in 2012, Walter?
San Francisco is clearly the leader. It had rent growth of 14.6%. Boston, Houston, New York, San Jose, and Seattle all had rent growth of 4 to 5%, which wasn't too bad, suggesting that technology and energy markets are doing fairly well. On a percentage of stock basis, actually, Phoenix, Austin, and Houston were on fire. They had 2% rate of net absorption, which is 2.5 times the national average. So we're seeing a broadening of the market improvement.
That's interesting. We have a lot of listeners in San Francisco. What's in the water out there? I mean, that's a pretty great, robust performance there.
Well, I mean, it's the tech industry, and it's a very supply-constrained market. There is no new there's one building underway in downtown San Francisco, and it's that fear of lack of supply that is driving tenants to pay up. And the other thing is San Francisco, remember, is recovering from the tech wreck that occurred in 2000. So they're likely to have some of the greatest peak-to-trough rent growth of any market in the country during this recovery.
Okay, well, great. That's interesting. Well, which cities struggled the most in 2012, Walter?
Washington, D.C. and Northern New Jersey, actually, both struggled significantly. Washington recorded near zero net absorption, which is, they normally get 2 million square feet. This is partly due to the normal election cycle, but it's also just general downsizing by the General Services Administration and some other tenants, and fear about what's happening with the fiscal situation in D.C. And then in Northern New Jersey, they lost about 300,000 square feet negative net absorption, and patents expired for some drug manufacturers like cholesterol-lowering drugs, and that reduced demand and caused rents to decline by 1.4%. Finally, it should be noted that New York, which is normally a very strong market, had 600,000 square feet of negative net absorption, which is just a drop in the bucket when you consider that New York is a nearly 800 million square foot office market. The demand loss was driven by the financial service sector and space cutbacks. But despite that number, New York still did achieve about 4% rent growth. So it wasn't that bad in New York.
That's right. Putting that in perspective. What about Class A versus Class B? Is Class A still performing better? What do you see there?
The Class A segment achieved double its fair share of net absorption. So it achieved 72% of the net absorption. It represents 34% of the market stock, so that's the reason why it got double its fair share. Rent growth for the sector was about 1.9% versus 1.5% for Class B. Clearly, we're seeing flight to quality, and Class A is definitely winning. Now, going forward, we expect that the extra performance of the Class A segment will probably diminish somewhat, but still probably capture half of the net absorption going forward.
Okay, that's interesting. Well, what about suburban market versus city market, CBD districts? What do you see there?
Well, clearly tenants are liking the CBD markets, and that's shown by the lower vacancy rates. CBD vacancies fell 30 basis points in the past year to 11.2, but the more telling thing is that they had 3.2% rent growth. They had only 7 million square feet of net absorption for the year, which represents half of the fair share, or 12%, but clearly the CBDs did well. The suburban markets, we like to break them into two groups. We call one is the premier suburban markets, which are the close-in, more supply-constrained locations. Those areas actually did pretty well. They had a 60 basis point decline in vacancy, the most of any of the segments, to 12.8. Now, rent growth was a little bit slower at 1.8%, which was 1 full percentage point below that of the CBDs. And then as you go further out, the true suburban markets, a lot of housing distress in some of those markets, and so they didn't have as good of a recovery, only 30 basis points. And vacancy rates are 13.8, or 1% higher than premier suburban and 2.6% higher than the CBDs. The higher vacancy rates in these outer suburban areas translates into basically no rent growth in the outer suburban markets.
Yeah, well, that makes sense. Were there any surprises or standout results, Walter, that you saw looking at 2012?
Removals of office space are a big deal. In fact, since the recession ended, over half of the decline in office vacancy rate, or 0.7%, has been accounted for by removals of office space. For example, in 2012, we had 59 million square feet of net absorption, but we had 18 million square feet of office space removed from the marketplace. Now, the removals are concentrated in markets like San Jose, Hartford, but also Class C office space. And that is that's a very big factor that we look at when we forecast.
That's interesting. So you add that with the lack of new construction that we've seen in many markets, and then you have an improving office market, right?
Yes, and some markets like Los Angeles, for example, where there's basically no significant construction, you actually have more removals of office space than you have additions.
All right, that's interesting. Well, what do you expect to see for the office sector moving forward into 2013?
So going forward, we had 59 million square feet in absorption this past year. We expect that number to rise closer to 70 million in 2013. That's an 18% increase. We expect the increase to basically reflect a similar job picture in 2013 to 2012, but less excess shadow supply, which was the lost space from the last recession. We're working that off. This should support about a 50 basis point improvement in occupancy rates, put vacancy in the range of about 11.5%, And the rent growth should ramp up. Last year was 1.7. This year we're looking for mid 3% type rent growth. We expect to see a fairly balanced capital markets. Supply and demand should be fairly balanced. No significant trends in pricing or anything like that.
Okay. And speaking of capital markets, we're short on the break here, but what happened with sales volume in 2012? Were there more office sales this year?
Office sales overall are up 7.8%. But the critical thing here is if you look at the institutional office sales, they were flat. But the smaller office sales, less than $25 million, were up 18% in the past year. And that is principally due to the capital gains tax increases. We think that a lot of people sold properties at the end of the year to avoid paying the higher capital gains taxes.
Yeah, we saw the same thing in our shop, people rushing to get deals done, and it was good for the economy. Maybe we should have those lower tax rates moving forward and get investment rolling. Walter Page, thanks for sharing your insight with us today.
Thank you.
If you'd like more information from or about CoStar Services, visit CoStarGroup.com. Well, after a quick break, we'll get more perspective on the U.S. office market for you. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.